Welcome to the Values Exchange podcast. I'm Mike Cruz, your host, author of Saturday Every Day, private pilot, and CEO of North Texas Wealth Management, a firm dedicated to values-based financial planning. I'm excited today for our guest. I know many of you are looking at the markets and such an important year with the election and wondering what to expect. So we have a great guest today to help us answer some of those questions about inflation and interest rates, and as an average investor, what you can expect and learn from our discussion. So my guest today is Dr. Jeffrey Roach. Jeffrey, thanks for being here with me. I'm excited to talk through some exciting topics.
Fantastic. Well, thanks for having me.
Yeah, so, over 20-year career, now the Chief Economist at LPL Financial, provided, briefings to the Fed, Wall Street analysts, global money managers seek out, his guidance, and of course a PhD in economics from Clemson University. Pretty exciting stuff. But, as I was looking at that, Jeffrey, what really led you to become the Chief Economist at LPL Financial? I'm sure that was quite the journey. You don't just wake up and decide to jump into that role. So how'd you get there?
Well, in college, I was a straight up math major because I loved the theory, didn't like the practice. I said, just give me calculus, give me differential equations, give me the stuff that, doesn't have much application. Well, lo and behold, I had a change of heart, realized, there's a lot of really interesting applications to the math side of things. So as a math guy, statistics guy, realized going on with the PhD, that was the natural progression. Then I knew I didn't want to stay in the classroom because I love people. I love tackling problems. I love business. I love understanding kind of the global nature of business, and start out my career at B of A and on the trading floor. Fantastic way to start. Didn't even think that they were speaking English. Coming out of graduate school, going on the trading floor, but a lot of interesting twists and turns. A couple of things that my key takeaways from where I started and how I got here: staying humble. Yeah, the markets will make a fool of you real fast, and staying humble, always willing to learn, trying to be creative. I think there's such an artsy side of the business. When you think about markets and understanding investments and preparing for the future, you got numbers to crunch, but you have to have the artsy side to understand and be creative in how do you approach the problems that the markets throw at your way. Sure. Every minute of the day.
Yeah, we always say the market will do whatever it has to do to surprise the largest number of people, for sure. So. So when we talk about like the average investor, very quickly, I know that we can get in the weeds and go down the path of differential equations, but it doesn't necessarily help, the typical investor and what they need to do in their portfolio. And so I think, one of the big factors is inflation that we're talking about this year. We haven't seen it in a long time. Help me understand, or help the average investor understand, that relationship between inflation and interest rates.
Yeah, right. So, there's so many different ways to think about it. And one of the things I like to do, when I talk to my parents or relatives, they ask me, Jeff, what's going on? How do I think about this? Is you think of inflation as kind of this rate of change in the price level of goods and services. So gallon of milk, the cost of doing business, the cost of raw materials. So what happens really is, in an environment where inflation gets out of control, think about some of the emerging markets. Even this year, we've seen some really unusual moves down in Latin America. Inflation that gets out of control basically erodes purchasing power from the average consumer. And so that's the reason why people care about it. It's an erosion of purchasing power. And when that gets out of hand, that does terrible things to an economy.
Sure, yeah. So my, $100 I have obviously will buy less goods and services as inflation increases. What are some of those drivers for inflation? What are the causes?
Right. So I'm a fan of Milton Friedman. Milton Friedman was an economist, a short little economist back in the day. And his phrase that was very helpful throughout his period, even interacting not just in academia, but he did interact with those in Washington, that typically inflation is a monetary phenomenon, and that is that when there is more and more money chasing after a a defined set of goods and services. And so as more and more money gets pumped out into the system, thinking about another way of saying loose monetary policy often is inflationary. And so you might say, okay, what are the causes of inflation? A number of causes. It's not just from the monetary side of things, think central banks. It can also exist and grow out of control because of poor fiscal management. So it's in the regulatory environment as well. So it's not just
Mm-hmm.
monetary policy. Typically, that would explain most of the challenges, money supply, but also you got to track fiscal policy, and regulatory policy certainly has important impacts on the price level.
Right. How much would you contribute our current conditions to the financial crisis in 2008? We had a significant, I would say, change in monetary policy at that point. And maybe even back to the dot-com era where we dropped interest rates in relation to decreases in market values, and then printing lots of money, expanding the money supply. So is that the new MO of the Fed? Is that just the new environment we're in and we expect that to continue? Or are we still just kind of riding the waves of those changes back in 2008 and back in 2000?
Well, it is really important to be a good historian when you think about understanding the current environment, and that's not just in finance or in markets, but it's in architecture, it's in music, theater. Understanding the current environment is definitely done well when you understand the history. I'm a musician, so hence I often use that analogy. And I think it's helpful for your listeners, Mike, to go back, 1950s. I think you have that famous statement from William McChesney Martin, Fed chair back in the 50s, talking about during times of economic expansion, the Federal Reserve there is required to remove the punch bowl before the party gets out of hand. Of course, Greenspan repeated that line, and we certainly see it with the current chairman thinking about that proverbial punch bowl. So, to answer your question, Mike, what's new? What's changed? Well, I think in many ways the Fed is trying to be consistent with its mandate since its creation in 1913. But as the economy changes, as demographics change, as the structure of markets change, perhaps there's slight modifications in how to tactically implement their mandate from 1913. So the punch bowl analogy from the 50s is still helpful, but things change. One of the things that changed really was back in 2020 when the Fed started talking about a long run target of 2%, meaning that sometimes there's a 2% target of inflation that policymakers look at. Sometimes it's running below that target. Sometimes it's running above that target. But there's always this look at this long run average. Well, if you go back several leadership regimes, you could say before Powell was Yellen, and then Bernanke, then Greenspan, Volcker, right? Going back in time, they were all using perhaps slight nuances to manage that dual mandate of price stability. So there's no 2% in that 1913 act, the Federal Reserve Act, but price stability, whatever that means, open for discussion,
Mm-hmm.
and full employment, whatever that means, open for discussion. So that's why, Mike, you're getting into the real heart of the matter. What's new now
Yeah.
relative to great financial crisis, .com, certainly the 80s had some interesting things going on.
Yeah.
The inflation environment of the 70s.
Sure. And so I'm glad you brought up both of those. Those are my next questions here. So, talking about the dual mandate, I think it's important for investors to realize the Fed's how they manage because, many of my clients will ask me, how far are they going to raise interest rates and what is that going to do to the stock market? and to realize that's not really the primary concern of the Fed. It's that dual mandate, like you said, price stability and maximum employment or full employment. Can you talk a little bit more about that dual mandate? What does that really mean? And I know there's many definitions, but when we think of full employment, how do they usually define that? And then how do they define price stability? And then kind of going back to what you were talking about with the history of the markets in the 1970s, and what did we learn during that time period of high inflation?
Wow. Well, here's a little bit of a sneak peek. I'll answer your question. There's a lot to unpack there. What I think is really fascinating, and here we are recording this in June, middle of June, but it's never too early, at least in my view, to think about the upcoming annual symposium that the Kansas City Fed hosts every year. Very, very important because central bank leaders from around the world show up in Jackson Hole, Wyoming for a couple days to discuss all kinds of things. Sometimes it's theoretical, but ultimately it's very, very practical. The theme of this upcoming conference is all about reassessing the effectiveness and the transmission of monetary policy. And of course, by definition, when you look at the phrase reassess, there's certainly a lot of implications from that phrase, reassessing the effectiveness of policy, meaning that as an economy changes, certainly policy or implementing policy needs to change. Okay, so going back to your question, thinking about the dot-com, thinking about where the Fed is with their dual mandate, but how does it impact inflation? And then the definitions. So full employment is often defined, and kind of as we drill into it, as a level of employment to unemployed. The available pool of workers needs to be big enough so that the market's not too tight, the labor market's not too tight, meaning businesses just can't find people, available workers. So the pool of available workers needs to be big enough, but it needs to be low enough so that the growth of real incomes can continue to support businesses. So you want an unemployment rate that's greater than zero, but you don't want an unemployment rate too high in order to really weaken just general economic activity. So that's the full employment side of thing. The price stability component is really something that needs to be taken into account in a global sphere. So you think about what price stability means. It means that businesses, when they think about expansion, when they think about managing their cash flow, whatever they're doing, price stability means that of all the variables that businesses and households think about in order to make prudent, wise decisions, the risk of inflation is not one of those variables they need to worry about. It's taken off the table, meaning it's stable enough for businesses and households to consider other important things to make those wise decisions.
Okay. And so, if we were to quantify that and we said full employment, I've heard, somewhere around, less than 5% unemployment is considered full employment. And I think there's a lot of numbers that are tossed around, but is that a reasonable, quantifiable measure there, about 5%?
It is a moving target based on what the economy looks like, right? So if you have the majority of your economy made up of 35-year-olds, that's going to be very, very different than what a good unemployment rate would be if your average age is 55 years old. So
Yeah,
that's
makes
going to
sense.
ebb and flow based on what the composition of the economy looks like. But you're getting at the heart of the matter. What's an unemployment rate that's healthy, that's not going to be inflationary nor deflationary, and it's somewhere between 4 and 5%. You're
Yeah.
exactly right.
Yeah.
And I think your follow-up question was probably going to be, well, what's the inflation rate that's stable, and that's your 2% target, and that's taken in conjunction with other major central banks around the globe in order to kind of say, okay, here's 2% inflation rate on the long run, that's stable.
Yeah.
Unemployment between 4 and 5, that's fairly stable as well.
Right. And I think, many investors or even consumers today are asking the question about prices, in that, yes, maybe inflation was, very significant. Prices went up very quickly, and now inflation is decreasing. But that doesn't mean prices are decreasing. Prices are still elevated, and then maybe increasing at a more moderate rate. And so what we haven't seen yet is really wages increasing. Can you talk about maybe the expectation for what we would expect for wages, or maybe what are those catalysts that would trigger wages starting to keep pace with inflation or catch back up?
Yeah, that's right. So real income needs to be the follow-up conversation. So you're exactly right. When we talk about 2% inflation rate, that's the rate of change relative to a year ago. Typically, annual rates of change is what you look at. Now, granted, we look at month on month and 6 month over 6 month, all kinds of rates of change. But 2% year over year, meaning that the price level, as you said, is
Yeah.
definitely higher than it was in previous time periods. And if we're not getting negative numbers, then price levels are not getting lower by definition. So the follow up is saying, well, are people getting paid enough to correspond to those higher prices? We're actually starting to see real incomes. In fact, earlier this year was pretty decent. It's quite a challenge. One of the things, Mike, as you know, one of the things that we are learning and continue to learn and manage through post pandemic is that one part of the economy might have a completely different experience on the inflationary dynamics and economic situation than another cohort of the economy. You're a homeowner that refied in 2021, you're feeling a lot different than, say, someone who's just coming out of a rental situation looking for their first house, or someone trying to negotiate again because they're a renter, not a homeowner. Two very, very different experiences all in one same big economy.
Yeah, that's a great point. I mean, the cost of borrowing is so high today. So let's kind of pivot and think about, maybe from the point of the investor, wondering probably, I think, two primary questions. So, long term, what indicators we need to look at. We can kind of circle back to that. But I think I want to start with maybe the reaction and the big reactions that we're having today for Fed statements. So, the Fed speaks, markets react. The impact of these announcements is so significant. Is it overdone? Is that the way that we expect it to kind of continue? Why are we hanging on every word of the Fed, and why does it move the market so significantly?
Well, that has been a favorite pastime of investors for a very, very long time. So I was just leaving graduate school, started on the Bank of America trading floor during the Greenspan era. And
Nice.
that definitely was a favorite pastime, trying to parse every nuance and word and eyebrow twitch of the chairman. And markets did definitely move on how Greenspan reacted. And then, of course, Bernanke, Yellen, Powell. So it's nothing new. I think it's probably fair to say that to the listeners to understand, this is nothing new, that the markets often get preoccupied from Fed policy, and of course, rightfully so, in the sense that you think about what policy makers do and their decisions on that overnight lending, what banks are charging each other for typically overnight lending, is is very important because it impacts all kinds of other important consumer products like mortgages, like CD rates and other investment rates. So it's very important, but the markets do tend to be preoccupied and will probably forever so be preoccupied with Fed policy and what they're saying. And the challenge now, I think, Mike, and this is go down this road if we want to some more, but the idea of being data dependent is nothing new per se, but perhaps we're transitioning to maybe just a more transparent Fed to say, okay, we don't have to read between the lines so much. Perhaps we're trying to figure out, well, what data are they dependent on when they say they're data dependent? And I think we've learned one thing recently, and that was the openings to unemployed ratio. That was one of the data points that they seem to be focused on, as well as core inflation, which means outside of the more volatile components, what are core prices doing? And then what are they doing when we exclude the rent side of things because we know that's really sticky. So services, insurance, some of those costs of vehicles, some of those costs are really important. That's one of the data points that the Fed is currently looking at.
Okay. Yeah, and so those are definitely those data points. And so, as an economist, if we start thinking about predicting as much as you can future inflation trends, what type of market data? What's your scorecard look like? What are you watching to think about those future trends, and then long term, what does that mean to the typical investor and how they manage their portfolio?
Yeah, it's great. So again, going back to the whole point of this is inflation tends to erode purchasing power. So you have to make sure that how you allocate your retirement accounts or whatever account, investment account you're looking at needs to have some component to say, we need to make sure we're covering for at least the rate of inflation and then a return on top of that. One of the things that I look at that's very helpful from a leading indicator standpoint is currencies, because that's one of the first steps into understanding how the inflation world works, the pricing world works, particularly in a global economy. So currency markets, particularly the dollar, as it's still considered the reserve currency of the world. So looking at currency trends, as well as looking at some of the other pipeline data. So import prices, producer prices, those raw material prices are very, very important as predictors for consumer prices at the end of the line. So understanding all stages of that pipeline. But these are very, very important to understand the trajectory.
Yeah, makes sense. And I think, we start thinking about inflation, we go right to the U.S., but when we start thinking about how that interacts with, globally and other currencies, I don't know if there's any simple way to really understand how all of that works together, but maybe you can just shed some light on it. How do you think about that kind of balance across, I guess, the global inflation, trends?
Yeah, well, that certainly was a big story right at the onset of the pandemic. So in 2020, we were living in the San Francisco Bay Area, and I personally watched the lineup of ships, container ships waiting, to
Mm.
get into the Oakland port. And then, of course, seeing satellite images and conversations with those that are in Southern California, thinking about the lineup going into Long Beach and LA ports. So, one of the things that's really important when you think about that global perspective, understanding how that impacts what you see domestically, and that is supply chains. And interesting to note, if the listeners want to get a little bit deeper on this, the New York Fed has a supply chain, like a pressure gauge, as it were, and you could watch that index ebb and flow as it measures multiple different points around the globe, understanding how the supply chain pressures are either increasing or decreasing over time. And they put that out every month.
We talked
I
about the
mean,
Fed mandate, but can you speak to how it's structured and how it kind of really works inside the Fed?
right. So that 1913 Act said, hey, you need to do price stability, you need to manage to full employment. But the act also talked a little bit about, well, how to do that. What's the structure? And people don't often realize this. It gets confusing, and maybe it's just the laziness of all of us who like to talk about this stuff. But there's really a couple different sections within the system. So we talk about the Fed this, the Fed that. Well, really, we're talking about specifically about the Federal Open Market Committee, the FOMC.
Mm-hmm.
They're the ones that come out with that statement saying, hey, we've either kept rates unchanged or lowered or raised. That's a committee that's made up of board of governor members, which is a separate entity. They're overseeing the Federal Reserve System, as well as rotating presidents of the various district banks across the country. So the Federal Reserve System has 12 regional banks. And what I like to tell people is, in the same way that we have a representative structure in Congress, in House and Senate, in many ways, the Federal Reserve has the same thing, has a representative nature to it. So you have a Dallas Fed which is independently run and has a board of directors from the private sector, from other banking institutions, et cetera. You have a San Francisco, you have Denver, you have a number of these regional banks that all have to their calling as presidents to represent their region. So the Dallas region economy is very, very different than, say, like the Boston region. Well, the nice thing is we have a representative nature built in to our Federal Reserve System.
Yeah, no, I think that's a great point, and probably something many are, maybe just not as aware of, or don't think of it that way. I know that, we know that we speak about the Dallas Fed, but we don't really necessarily think about it being a representative of our area, which is a great point. So, and throughout this, we talked about the 70s, we talked about history, we talked about things that are maybe different today. And I think, for what we do for our clients, it's still really staying invested over the long term. If we look at the 70s, the ones, investors that were successful were the ones that invested in stocks over that time period, where inflation really tripled. It was the only place to really keep pace. I think one of the mistakes people are making today is maybe going to too much cash and kind of missing out on really keeping pace with inflation over the long term and realizing the long-term gains that the equity markets provide, but then also staying data-driven. So as we look at these, macro factors, we can then tilt the portfolio in times where we may want to take on a little bit more risk, or maybe even pull back and take on a little bit less risk, or take advantage of some high interest rates or different environments. And so tilting that portfolio is really important when we do it, as long as it's, data-driven decisions. And so that's really what we do for our clients and investors. Always looking ahead, mid-year, it's a great way to think through, as we go into an election year, look at, low volatility today, but maybe increased volatility later in the year. How can we position the portfolio to stay ahead of that curve rather than looking in the rearview mirror? So, if you're one of our clients, we already have that covered. If you're not one of our clients and you'd like to talk about your portfolio, love to help you think through the strategies that help investors build wealth over the long term, not necessarily a knee-jerk reaction to any particular Fed meeting or anything else. But thanks for tuning in to this episode of the Values Exchange podcast.